Welcome back, everyone. My name is Edmund Schuster. I'm standing in here for Mark Moore. A great event. I've learned a lot so far, and I'm particularly excited about this next session. I have to admit, had you asked me 2 years ago what we would be discussing in a forum like this, my guess would not have been the kind of the resurgence of retail investors. But this is something that we've all experienced over the past year and a half. And our first paper will be presented by Jill Fisch, and it's on GameStop and the resurgence of the retail investor. So I'll hand it over to you, Jill.
Okay, so it's a great pleasure to be here. This is a super interesting program, so I feel very lucky to have the opportunity to present. This is very much a work in progress, as you can see, among other things. The name keeps changing slightly, and I'm just going to have time to hit some of the high points. So let me go ahead and try to do that. There we go. Okay, so this session, both my panel, my paper, and Sergio and Christina's paper shift us from retail investors. And as you can tell so far today, nobody's been focusing on retail investors. Large institutional investors dominate. Right, there's the big three. Retail investors are supposed to basically invest through intermediation. They're supposed to buy diversified mutual funds. We regulate the intermediaries. We try to regulate fees and conflicts of interest and so forth. And that's supposed to be sufficient. But you've already heard some of the reasons that institutional ownership might raise potential concerns. So we talked in one of the earlier papers about common ownership. Their mutual funds themselves face internal governance and conflict of interest problems. Number of people have written on problematic incentives, particularly by index funds. Jeff's paper is an attempt to respond to that. And I've been thinking, particularly as we get away from the sort of pure governance and economically driven initiatives into the ESG area, that the intermediation itself, the separation of the mutual fund decision makers from the people with skin in the game, presents its own set of problems, right? So my paper focuses on retail investors. And as I said, we have always been sort of accustomed to institutions taking charge. In the winter of 2020, things changed. There was a pandemic, you might have known. A number of countries locked down to various degrees. People started working from home. People started depending a huge amount on technology, right? So there's some technology. The government distributed in the US at least pandemic relief checks, and retail investors began to enter the stock market, right? This was something new. This was something that people weren't really prepared for. Right? And those are some of the tools that retail investors started to use. So retail investing isn't actually as new as you might think. So Sarah Hahn has some historical work on this, right? This is just one little quote. She's done some brilliant work in this area, but she basically said, you know, major manufacturing companies in the 1940s, at least one survey finds 91% of the common stockholders were individuals, right? Today, that's, you know, completely reversed. Right. In recent years, direct retail ownership has pretty much gone out of fashion. And if you ask why, well, most people aren't particularly interested in the stock market. It's complicated. People are busy. Everyone tells retail investors you shouldn't invest directly in stocks. You should invest through diversified mutual funds, leave it to the experts. And so institutional investors dominate. Right. And then GameStop happens. Right. So very brief history on GameStop, right? What happened? There were some early retail investors as early as 2019 that got interested in GameStop. GameStop was trading in, you know, $4 a share in August of 2020. There's an activist that purchased a substantial stake, has some plans to change the company. Retail investors led by Keith Gill or Roaring Kitty get active on social media. The price starts to rise. When the price starts to rise, some big hedge funds said, you know, there's nothing behind this. GameStop is an obsolete company. So they took short positions, and sort of the retail mob got underway. So what happens is eventually the price moves from $4 a share to a high of $483 a share in less than a year, pretty dramatic price increase. Trading volume is huge. On one day, the New York Stock Exchange had to halt trading 7 times. There was this little incident when Robinhood and a number of other retail firms suspended trading in response to increased capital requirements by the clearing firms. And it wasn't just a single company. The frenzy spread to other so-called meme stocks. And as of January of 2021, 28% of US investors had invested in one or more of these meme stocks. Right? So very briefly, a lot of scholarly commentary, regulatory response. Congress held 3 separate hearings on the GameStop frenzy. The SEC has announced on any number of occasions various initiatives to look into and respond. And the response falls in 2 categories. One, maybe we need to change things to protect retail investors from the market. And 2, maybe we need to change things to protect the market from retail investors. Right? So in terms of protecting retail investors from the market, right, there's a Vermont regulator who says, look, this could cause significant harm. GameStop, this meme stock frenzy, this is speculation, right? People shouldn't put their hard-earned money in jeopardy, and maybe regulators should step in and protect them from doing so, right? So, you hear retail investors are unsophisticated, they don't belong in the market, they're going to misuse dangerous tools like margin trading and options. They're going to be swayed by social media, right? That's a little Reddit thing. They're vulnerable to gamification, right? So, if you give them bright colors and confetti and little scratch off things, then they're going to trade more stock. They're victims of payment for order flow. So a number, particularly Robinhood, but a number of the sort of fintech app-based brokerage platforms don't charge commissions. They get their money from payment for order flow. I don't have time in 15 minutes to go into payment for order flow here, but that's potentially a problem and creates its own set of conflicts. Right. So second set of concerns, protecting the market. Here I've moved from Vermont to Massachusetts, right? GameStop speculation is a danger to the market. Well, that's pretty simple and straightforward, right? Why is it a danger to the market? Well, one problem is price volatility, right? I said when a company's stock price goes from $4 to $483, that seems to be a problem. And by the way, it wasn't just kind of a straight path upward. There were a whole lot of ups and downs, and there continue to be. This might create market fragility. The volume of trading, the amount of leverage-based trading, the possibility that retail orders are not going to be able to make good on their orders or meet their margin calls, trade failures. That's part of the reason for the increase in capital requirements that were imposed on Robinhood and other firms. And finally, the speculation, this is a threat to market efficiency and capital allocation. Right? AMC, one of these so-called meme stocks, said, oh, gee, our price is really high. It's time to sell some more stock at this high price. Let's raise some capital. And who knows what AMC's future is, in light of the sort of continuing COVID concerns. So how compelling is the case for regulatory reform? I guess in this paper, I'm not so convinced. Right? First of all, we're talking in these meme stock cases about publicly traded companies listed on national exchanges, subject to regular reporting requirements and supervision by the Securities and Exchange Commission. Right? These are not instruments that are traded off market. They are not instruments like private companies in which there's no publicly available information. And the point of this burdensome regulatory system is so that retail investors, unsophisticated investors, not just BlackRock and Vanguard, can participate. That's why we have the market system. Right? And the flip side of that is retail investors are already locked out of many investment opportunities that don't meet that, regulatory seal of approval. The story about speculation and how much retail investors can lose, well, if you dig into this, it's hard to find compelling evidence that retail investors suffered substantial losses, right? Yes, there were some that lost money. There are some who lose money when they go to Atlantic City or Las Vegas, right? But by and large, these were relatively small accounts. Some people made money, some people lost money. It doesn't seem like a dramatic societal problem. As I said earlier, intermediation presents its own risks. Meme trading doesn't appear to have spread to and destabilized the broader market, right? The volatility really was concentrated in a handful of companies that had some distinctive characteristics, relatively low overall float, or unusually high short interest, or low stock prices, companies for which price movements we might expect to be more dramatic. And finally, is it really bad for investing to be fun? I mean, I teach securities regulation. I keep telling my students securities regulation is fun. It's never clear that I persuade them, but I'm not sure it's bad for the country or the world for investing to be fun. So let me take the other side of the argument for just a minute, right? The advantages of retail engagement, right? First of all, capital market participation. For years, we've been trying to figure out, why don't more ordinary people invest in the market, right? It's an important tool for generating wealth. There are whole swaths of society who miss out, including younger investors, including diverse investors, including women, because they are afraid to, or bored by, or for whatever reason don't participate in the markets. So that's one advantage if retail investors are more engaged. A second one is it's valuable to have a citizenry with skin in the corporate game. Increasing the connection between citizens and corporations can give citizens a stake in corporations not just doing well, but acting responsibly, increasing corporate accountability, right? It injects a level of democratic process into corporate operations. So years ago, a guy named Lewis Kelsey started talking about citizen capitalism. This idea that it was really, you created a bridge. His bridge, he invented the ESOP. His bridge, his idea was to make employees shareholders in order to give employees a different kind of stake, right? So we talk about GM, let's make the employees of GM stockholders, and then the workers' interests and the shareholders' interests can be sort of sorted out through the preferences of shareholders. But obviously you can expand that idea quite a bit more broadly. So earlier we were also talking about the problem that a few large institutional investors might have too much control, might dominate the market, might engage in groupthink. And bringing in citizens, engaging citizens, counterbalances that possibility. It includes in corporate preferences a wider range of viewpoints. And finally, right, stakeholder governance, hot topic right now. Well, ordinary citizens are not just shareholders, they're stakeholders, they're employees, they're members of the community, they're customers. They bring those perspectives even to their engagement as shareholders. So those are some of the advantages I see in retail engagement. And finally, financial literacy. Right? Financial literacy is a long-standing problem. This is a way of getting people interested in financial literacy, seeing the payoff, and in some of these platforms, actually providing a mechanism for financial literacy. All right, I've got like 2 minutes left. So how should regulation respond? These are all issues that I think are worthy of attention, but since I don't have time, I'm not going to talk about them all here. Let me just spend a minute on platform regulation, because what I think is really new, right? Social media has its own problems. They're big problems. They go beyond just the capital markets. I was just listening to a show about the January 6th insurrection, so I'm not going to talk about that. Retail voting, I'm hoping Sergio is going to talk about that. I think that's a really interesting problem as well. But let me talk a little bit about platform regulation, right? So apps are still brokers, right? We shouldn't forget that. And brokers are subject to extensive existing regulation, right? Disclosure, conflict of interests, customer protection rules, and all of that. I'm not saying that because you're an app, you get a pass or it's a workaround, right? We've got to look at the information that the apps are putting out. And if something qualifies as a recommendation, or if apps aren't doing their job in terms of qualifying customers for option trading, that's just a matter of enforcing existing law, right? What might be different is the app's ability to use customer information, to collect information, then rely on algorithms to nudge or to present or to modify customer behavior. That's an interesting question. Of course, again, it's a question that's not unique to brokerage apps. We do this all the time with, sales advertisements, right? Facebook shows you an ad for a product based on your search history. But that's something that's worth paying attention to. right? But the dangers of attractive design, right? It's not limited to capital market participation, right? So, we can get nudged into all sorts of bad behaviors, right? And I think the benefits of citizen capitalism warrant our being cautious, not being too heavy-handed and saying, gee, just because something causes people to behave differently, we should regulate it out of existence. I think that's too extreme, right? Platforms also offer unique opportunities. We can reach more investors, the people who would be afraid to open a brokerage account, because let's face it, today, most brokers don't look like a lot of the population. And, historically, women and minorities have been afraid to open brokerage accounts because they're afraid they'll be judged. Coupling investing with engaging just-in-time tools for improving financial literacy. A lot of potential here. Right? And finally, extending the frenzy to voting, right? What I mean by engagement is not just engagement in terms of stock trading, but we even see as people are going back to work, as they've spent a lot of their pandemic checks, the interest by retail investors in the capital markets isn't dying out. And I hope instead of trying to stamp it out, we can, fan the flames and, make this an ongoing thing. So those are my conclusions, but I'm out of time. So thank you.
Thank you very much, Jill, for a fascinating presentation, perfectly kept time. And I expect there to be some lively discussion around this. I have April. April, I think your hand is up.
Yes. Okay, so Jill, I agree with everything you said, and particularly about retail investors, in a sense, should be encouraged. The one thing I wanted to ask you about is this thing which you struck through, which has to do with the social media. Because, we always think of investors getting their information from financial reports, and this, of course, is, they go into the SEC, and we have auditors. But it seems that particularly in this frenzy and other, things that can happen with retail investors, that a lot of information is coming from Twitter, they might be coming from Facebook, and this is out of the realm of what the SEC is going to be monitoring. So I was just wondering if you had any thoughts. You must have had thoughts because you had it on your slide. So I was just wondering what your thoughts were about retail investors using of Twitter, for example, as their primary source of information, and what, if anything, can be done about that.
So great question, April, and I have thought a lot about it, and I don't have any easy answers, but just a couple of thoughts. One, the problems or the potential problems of misinformation through social media, again, not limited to the capital markets. And frankly, if I'm worried about protecting people from social media, I'm more worried about insurrections and COVID misinformation and things like that than misinformation about GameStop. It's a really big issue. Yes, there is a difference in terms of social media in that people can post things anonymously, and that social media also uses tools like algorithms to direct information and kind of stir people up. Right? So those are particular risks. I'm not a platform expert. I don't know how you fix those problems, but you're right. It's to a certain extent out of the SEC's purview. But just the other thing I would say quickly is that for years and years, the SEC is worried a lot about where are people getting their information from? Are people getting the wrong kind of information? Should people be relying on research analysts? Should they be relying on SEC filed documents? And I'm not sure we can be so paternalistic, right? If you look at the younger generation today, they get a lot of their information from Twitter and Facebook and all of the different social media platforms, rightly or wrongly. And it could be that those platforms offer better, more accessible tools for things that I was talking about, right? Not just trading information, but voting information, engaging people on what the issues are and explaining it in terms that are easy to understand, or explaining the risks and the advantages of option trading. So, I think that there's a lot of flexibility, a lot of potential there. And I would hate for, whether it's the SEC or the FTC, some other regulator, to kind of step in and cut this experiment short, so to speak.
Great, thank you. I think Annette is next.
Yeah, thank you, Jill. Very interesting presentation. So I have been thinking about this quite a lot, and I want to address the question of financial literacy. So actually, I think it goes the opposite direction. So when you see this, like, well, I'm teaching like valuation for my students, and this all happened just before the course, and I was like, okay, what's going on? How I'm going to explain? Yeah, so there is the price should kind of reflect the value. Yeah, so it's definitely is not reflecting it here, both in GameStop and also in Dogecoin. Yeah, so kind of my reading of that was or concern that this is actually decreasing the financial literacy, because all these like novice traders, like actually teenagers sometimes, and inexperienced traders, they get this idea that this can happen, and then it's kind of the price is not related to underlying value. I think so. How would you comment on this, that this actually can decrease this financial literacy?
So when you say decrease, I'm not sure that that's entirely fair. I mean, the fact that people are trading without necessarily doing a fundamental value analysis doesn't mean that their financial literacy is in some sense being reduced. And the point is that being a market participant gives you some reason to search out and pay attention to the kind of tools that perhaps you ignored when you were just investing in diversified mutual funds, or worse, when you weren't investing at all, right? So, you know, one of the challenges that we have with financial literacy education is, number one, people don't want to do it. They think it's boring. They don't think it's relevant to their lives. And number two, to the extent we provide it, we don't necessarily provide it in connection with financial decisions. And that's where I think app-based trading is really potentially valuable, because you can link it up. And there are a couple of these brokers that are just starting to do it. Robinhood is doing a little bit. I know they just hired a new person. I think they could do a ton more. But, you know, starting to say, okay, when somebody is, you know, when they download the app, or when they try to get approved for options trading, you know, here are some tools that we can just push out to them right in the moment that might increase their knowledge base, right? Where do you have that opportunity otherwise?
Thank you, Jill. If I may just squeeze in one quick question. I like listening to you, I think I agree, given the experience we've just seen, right? But I wonder what will the next stage look like? I think part of the reason why we haven't seen massive losses on the retail side is that the traditional institutions were just not prepared for this. And so I wonder whether we can actually take this kind of singular event, or the first event, as a good guide for kind of the regulatory ambition that we should have in this area.
So absolutely fair question, right? Past prices are no indication of future performance. So whatever's happened in the last year and a half, I'm not going to infer anything. You know, I totally agree with that. But what we can take away is people opened accounts, and people, for the most part, actually are not just doing day trading, right? People are doing something that I think we can reasonably describe as investing, including a big segment of the population that's never done this before. Right. And I talk about people, particularly younger investors and minorities and women who didn't have as much capital market participation. It isn't just that they're putting money into the market. This may also be motivating them to invest, as opposed to gamble, as opposed to spend. Right. And, you know, my hope is that that's promising for the long term. And I think that these tools of engagement, right, that other people are talking about this. If you look at FINRA's survey found the number one reason that people gave for opening these new accounts was saving for retirement.
So I think we're almost out of time. I see that we have one question in the Q&A tool by Vanessa. So just reading this out, it seems that a way to approach and engage diversified retail investors would be paramount to mitigate the impact on ESG of regulations, such as the Florida Mind Your Own Business Act, which enables shareholders to hold woke corporations accountable for corporate decisions, not done in the shareholders' best interests. The question is whether you kind of thought about that aspect.
So that is so cool, Vanessa, because I have not even heard of the Florida Mind Your Own Business Act. And I've got another paper that I think that's relevant to. So as soon as this conference is over, I'm going to research that and figure out what I think. But the sort of more general answer to your question is I actually don't know what retail investors think. I don't know if they're to the right or the left of BlackRock and Vanguard. I don't know if they're polarized and they're on both sides. What I'm saying is these are the people whose money is invested in companies, right? And whatever their views are, I think they should have a role in affecting corporate decisions. And it shouldn't be a handful of asset managers that call the shots.